it's Michael from Trimline. In this video, I want to talk you through budgeting for your activity statements and give you a look at how these numbers are calculated so you can start thinking ahead of the game and have this cash set aside so when the big bills come each quarter or each month, you know what they're going to be and you have the cash there. So it's not a huge rude shock and you don't have cash problems, because this is a really common challenge with small businesses that I see, and they end up on tax debts, they end up with getting charged interest, and that compounds and it becomes a huge problem that you can avoid if you know a little bit about how it works. Let's dive into it. You'll remember this from our previous video where we talked through the big three that are collected on the activity statements: goods and services tax, pay-as-you-go withholding on your staff's wages, so that's your staff's income tax that you have to pay to the ATO, and then the pay-as-you-go installment, which is your company income tax that the ATO would like you to pay each quarter. So you chip away at it. So those are the three key ones we're going to have a look at. Let's have a look at how they're calculated. So GST should be fairly simple. Hopefully you understand. In this example, let's pretend it's a quarterly BAS. You can see 220 units have been collected, but 2 of those are GST on sales. 110 units have been paid in GST on expenses, but only 1 unit is actually GST related. So 220 bucks and 20 bucks of GST, 110 bucks, 10 bucks of expenses that we paid. So all you need to do is just net off those 2 units with the one that we pay, and that's the GST owed to the ATO. Fairly simple, right? If that was swapped and we'd spent 220 bucks in expenses and we'd received only 110 bucks, the ATO owes you 10. So that can move up and down depending on the month's results, essentially. So in terms of GST impact on a P&L, this is an annualized version. We imagine a $3 million agency, and the agency's entire operations exist in Australia. All their expenses are in Australia. All their revenues are in Australia. 3 million, so they'll have 300 grand of GST that they've collected on those sales. And if we assume that all of their cost of sales plus other operating expenses all had GST on them, so 10% of the 600, 10% of 300, we collected 300 and we paid 30 plus 60, which is 90, and then we owe the ATO 210 bucks. That's on an annualized basis. In reality, this is calculated each month and paid quarterly for most people. So I just wanted to give you an understanding of how this is extracted from your profit and loss and where it is. You'll often get probably questions from your existing bookkeeper or tax accountant with queries around, hey, did this include GST? Hey, can you please send this receipt to HubDoc or Receipt Bank? We need to understand what the GST is. This is because there's nuance in it. Not everything has GST on it, and the overseas related items, you have to obviously have GST free. So it's not as clear cut as this example, but this is for simplicity, of course. So that's step number 1, GST. You collect some on your revenue, you pay some on your expenses, you net them both off, and either you are owed money to the ATO or they owe you. Fairly simple. So that's step 1. Step 2, let's talk about employment liabilities. So if you have a look at this zero payslip that I got from the demo company, you can see the liabilities here sit as taxes. That's the pay-as-you-go withholding. And we can also see the superannuation here, which is really important to calculate as well. So those are the 2 things we're talking about when we talk about employment liabilities. The confusing thing with this zero, how zero lists it, so you can see that 13 grand from the payslip, 2 grand is pay-as-you-go withholding, and then they list the 9 grand of the 953 superannuation. In my head, I always think that the 10, the 9, the 2 should add up to 13, but they never do, because super is excluded from the calc. It's just on the net pay and added 11%. I know that's kind of ridiculous, but essentially the net pay there of the 10 is just 13 less the 2.8. Anyway, that's a minor gripe with how zero lays out its stuff. Essentially, the total cost of the biz is the 13 here plus the super on top. That's why I find it's confusing, because it doesn't show you the total cost of the business in this line here. Anyway, how it's calculated. Employment liabilities, assuming it's a $1.2 million business with super on top, so 1.3 total. Each month we're paying about 100 grand in wages plus 11 grand in super. So the 11 grand prediction of super each month is fairly simple. It's just 11% of 100 grand. And then for this very simple forecast, I've assumed around 23% withholding on each month's bill. That exact percent will change depending on the makeup of your team. Some people are on higher marginal rates, the high paid people, lower paid will be on lower rates. So it depends on your team mix, but this is just a simple approximation. What I want you to understand with this forecast is that these liabilities build up over the quarter and then they become due after the quarter. Again, they're built up October, November, December, and they're due once that quarter is closed. The exact date depends on if you have a tax agent or a BAS agent, but what I need you to start thinking about is, hey, there's these big cash flow hits each quarter that I need to start thinking about and start kind of approximating what they'll be and have that cash set aside. So these are 2 really big ones, the withholding on your team members' payroll and obviously your super as well. And you can see that just happens like clockwork each quarter. builds up. And as you grow and you get a bigger labor bill, these numbers get bigger. And if you don't have the cash set aside, you get into a cash crunch. So that's where it's really important to understand this stuff. The final one is just the pay-as-you-go installment. So that's essentially looking at last year's tax return, and the ATO said, hey, last year you did 3 million, you made a net profit of 900K, which is decent. Company tax rate is 25%, so you owe us 225. And then the very simplified version of this is that they'll say, all right, well, last year you paid us 225. Let's pay that this year, each quarter, assuming you'll do about the same as last year. So there's an assumption that we'll base it on last year's results. In reality, businesses change each month, each quarter. So you can adjust this down if you need to due to a change in trading conditions to say, hey, we're not going to be as profitable as last year. We've had a real down quarter or down month, and you can reduce that assumption. But essentially, the ATO want you to be paying something each quarter as you go, so you don't have a big tax debt when it becomes due after the end of the financial year. So you're kind of paying as you go or installing your company tax ahead of the game. And that's how we're getting that 56,250. It's just last year. So last year's divided by 4 for each 4 quarters. But as I said, in reality, you can adjust that if you need to, depending on what's happening in your business. But that's the high level way to look at it. And then you can see this very simple forecast with all of those combined. If we think about a new financial year, July, August, September, and then in October, you'll have all of those things due. The GST will come due from that previous quarter. Pay-as-you-go withholding will be due from the previous quarter. The installment based on last year's tax return becomes due. So you can see how these numbers start to add up, right? On a $3 million agency, that's 131K in your BAS, plus another 33K on your super for your team. So that means for this business, this $3 million agency, they need to have 165 grand set aside for this quarterly bill as it comes in. These are simplified numbers, but it's still a huge amount of money. And if you're in a growth phase and you're thinking about using money to invest in other things in the business, this cash may not be in your bank account when it comes due. So that's why having an understanding of this is really, really important. So you can know that you have to have the discipline to not touch it. The number that I gave at the end of the last video was around 20 to 30 cents of every dollar that you should put aside or not touch. You can actually be a lot more detailed with the exact number you have to have set aside, as I've shown you in this forecast. So you can obviously forecast the GST that you're going to have to pay based on how the sales and expenses went for that quarter. So you can actually get a more approximated number. Same with the employment liabilities. You can forecast it out and actually look at what your payroll reports are telling you in terms of the wages you have to withhold, the super you have to withhold for each month. And so you can have a much more detailed understanding of, hey, that will be my bill. Put that in a different bank account. So you can actually get very specific with what this needs to be and have a chat about your accountant to make sure you're doing this. And then the installment, as I said, you've got a bit of flexibility there. You can amend that up and down, but the ATO will come knocking and want something. So that's a high level view of how it all works. And you can see, let me give you a quick high level view of my, if I sense check this. So I'm saying each quarter you have to put aside 165 grand, right? So let's go 164,750 times 4 for the 4 quarters of the year, which is about 659 grand overall for the full year. And then if we look at this annual $3 million business, we divide total bill, the cash bill that you're going to have to pay on this $3 million business, that's about 22%. So that kind of rough rule of thumb that I gave you of put aside 20 to 30 cents of every dollar and that it's not yours, you can see by this calc, that rough rule of thumb kind of works, right? It's lower. It's 22%. So 30% would have been too aggressive. You might have had some funds set aside, but it clearly shows you that there's your money, which is the company's money, and then there is the ATO's money, which you cannot touch and you need to pay them. And then there's also the super that you need to remember about. That's your employees' money that you also need to pay. So hopefully this gives you an insight into forecasting ahead, what an activity statement is, what each of these terms mean, and hopefully with this insight, you will start being more disciplined with putting money aside so you don't get into these troubles and you build up a nice healthy cash reserve to get you through any troubles. All right, thanks for watching and I'll see you on the next one. Cheers.